Hi everyone, and welcome back to my channel. Today, we're diving into a topic that's close to my heart: smart tax strategies for high-income earners. You work so hard for your money, and the last thing you want is for a big chunk of it to disappear come tax season. We're going to unlock the secrets to minimizing your tax liability and maximizing your wealth. Let's get started. Let's be real, nobody loves talking about taxes, right? But here's the deal. Understanding how taxes work, especially when you're bringing in a significant income, is absolutely crucial to building long-term wealth. Many people think that earning a high income automatically means paying a hefty amount in taxes. While it's true that you'll likely be in a higher tax bracket, it doesn't have to be a financial drain. Think of it this way. The tax code is like a financial roadmap. There are paths you can choose that lead to paying more in taxes, and then there are paths that can help you keep more of your hard-earned money. That's what we're going to focus on today, those strategic paths that can make a real difference in your financial life. Now let's talk about one of my favorite topics, retirement planning. I know retirement may seem ages away, but trust me, it sneaks up on you faster than you think. Plus, when it comes to taxes, maximizing your retirement contributions is like finding a golden ticket. Why? Because contributions to accounts like 401(k)s and IRAs often come with some amazing tax advantages. When you contribute to a traditional 401(k) or IRA, you're essentially lowering your taxable income for that year. That means you could potentially be in a lower tax bracket and pay less in taxes right now. But the benefits don't stop there. The money you contribute to these accounts grows tax-deferred, which is a fancy way of saying you don't pay taxes on those earnings year after year. That means your money has more potential to grow and compound over time. Let's move on to another powerful tool in your tax-saving arsenal: health savings accounts, also known as HSAs. These accounts are like a triple threat when it comes to tax benefits. First, just like with traditional 401(k)s and IRAs, contributions you make to an HSA are tax-deductible, lowering your taxable income. Second, the money in your HSA grows tax-free, just like your retirement accounts. And third, when you use the money in your HSA for qualified medical expenses, those withdrawals are tax-free as well. It's like a trifecta of tax savings. Now, to be eligible for an HSA, you need to be enrolled in a high-deductible health plan. But if you are, it's definitely something to consider. For 2023, the contribution limit is $3,850 for individuals and $7,750 for families. Think of it as a way to invest in your future health while saving on taxes today. Now, let's talk about investing. Investing your money wisely is essential for building wealth, and it can also be a smart move when it comes to taxes. Have you ever heard the saying, "It's not what you make, it's what you keep"? Well, that couldn't be truer when it comes to investing. Choosing tax-efficient investments can make a significant difference in the amount of taxes you pay on your investment gains. One of the best ways to invest tax-efficiently is to consider low-turnover index funds and exchange-traded funds, ETFs. These funds are designed to track specific market indexes, and they tend to have lower trading activity, which means fewer taxable events. Now, let's talk about something that's near and dear to my heart: giving back. Donating to charitable causes is not only good for the soul, but it can also be beneficial for your tax situation. When you make charitable contributions, you may be eligible for a tax deduction, which can lower your taxable income. Now, it's essential to keep in mind that to claim this deduction, you'll need to itemize your deductions on your tax return. And of course, it's crucial to choose charities that resonate with you and align with your values. If you're someone who regularly makes significant charitable donations, you might want to consider setting up a donor-advised fund. This type of fund allows you to make a charitable contribution and receive a tax deduction in the current year, even if you don't plan to distribute the funds to specific charities until a later date. Now, let's talk about a strategy that can feel a little more advanced, but can be valuable for those who invest in taxable accounts: tax loss harvesting. Tax loss harvesting is a strategy where you sell investments that have lost value to offset capital gains you may have realized from selling other investments at a profit. By offsetting your gains with losses, you can potentially reduce your capital gains tax liability. It's like strategically taking a loss on paper to lower your overall tax burden. However, there's a crucial rule you need to be aware of when it comes to tax loss harvesting: the wash sale rule. This rule essentially states that if you sell an investment at a loss and then buy back the same or a substantially identical investment within 30 days before or after the sale, you can't claim that loss for tax purposes. We've covered a lot of ground today on how to unlock your wealth through smart tax strategies. Remember, understanding how to leverage the tax code to your advantage is key to keeping more of your hard-earned money and achieving your financial goals. If you found this video helpful, please give it a big thumbs up. Subscribe to my channel for more financial empowerment tips. And don't forget to hit that notification bell so you don't miss any future uploads. Thank you so much for watching, and I'll see you in the next video.